Hey, this is Rob, the Ignorant Entrepreneur. It's hard to beat dividends. If you buy shares of a healthy and growing dividend-paying company, you can look forward to receiving dividend payouts regularly, no matter whether the economy is booming or sinking. Yes, some struggling companies will occasionally decrease, suspend, or eliminate their dividends, but that happens relatively rarely. On top of those dividend payments, you can also expect the share price to grow over time, while the dividend gets boosted as well. Hold on to a great dividend payer long enough, and you might end up receiving as much in dividends over the course of a year from a single share of the stock as you originally paid for that share. Without further ado, here are 3 solid dividend-paying stocks that should pay you year in and year out. Number 1, we have Digital Realty Trust, a REIT, a real estate investment trust. REITs are required to pay out at least 90% of their income to shareholders, and Digital Realty Trust has recently supported a dividend yield of 3.1%, and it has been paying a dividend for 15 years now. Most people familiar with REITs imagine traditional real estate categories such as offices, apartments, shopping centers, and medical facilities. Digital Realty Trust is one of only a few companies in a relatively new real estate niche, data centers. Thus, it owns many data centers and leases them out, collecting income from its tenants. Its customers may include big-name technology companies that need to house a lot of equipment. Think of all those cloud computing companies, for example. Whatever you store in a cloud or access from the cloud, such as videos you streamed last night, are housed in some sort of physical equipment somewhere, probably in a data center. Digital Realty Trust's future looks quite promising, as our modern society is likely to use more and more data, in part because more products we use are becoming smart, needing to store and access data. Think, for example, of smart cars, smart thermostats, and even smart refrigerators. Indeed, forecasters at IDC have predicted the amount of data created over the next 3 years will be more than the data created over the past 30 years, and the world will create more than 3 times that data over the next 5 years than it did the previous 5. Number 2. Starbucks. Global coffee powerhouse Starbucks needs little introduction. You may not think of it as a dividend source, but the company does pay a dividend, which recently yielded 1.8%. That might not seem like a lot, but it's roughly on par with the average yield of the entire S&P 500. Remember too that a dividend's growth rate matters a lot, and Starbucks has been hiking its payout at a good clip. Over the past 5 years, it has increased at an annual average rate of 17.6%. Starbucks has been able to increase its dividend yield aggressively because its business has been growing. The ongoing pandemic has presented a major headwind, but Starbucks has responded well, opening new drive-through windows and introducing curbside pickups, among other things. In its last quarter, the company added 480 more locations, bringing its global total to 32,660, about half of which it owned and operated as opposed to franchising. Starbucks is expanding more aggressively abroad and domestically too, as there is more growth potential outside of the US, where it is rather well established. Operating costs are lower too, in many countries. And lastly, perhaps less known, number 3, Brookfield Infrastructure Partners. Brookfield Infrastructure Partners, unlike Starbucks, is far from a household name. It's well worth getting to know though. For starters, its dividend recently yielded 3.8%, and that payout has grown by an annual average of about 9% over the past 5 years. Note too that it's a master limited partnership, which means that there are special tax rules for it and its investors, so read up on MLPs before investing. The company's name hints at what it does. It describes itself as one of the largest owners and operators of critical and diverse global infrastructure networks which facilitate the movement and storage of energy, water, freight, passengers, and data. The company's objective is to generate a long-term return of 12 to 15% on equity and provide sustainable distributions for unit holders while targeting annual distribution growth of about 5 to 9%. If you take the time to look at some of its assets, for many years it looks like Brookfield Infrastructure Partners is positioned to profit. You may want to take a closer look at this company as a potential investment. Each of these 3 companies could serve you well over the long run, generating significant dividend income that ideally you can reinvest in more shares of the stock. If you're in retirement, such stocks can generate income to supplement your Social Security checks. After all, the average Social Security check was recently less than $1,500 per month. Now again, this was Rob, the Ignorant Entrepreneur. Thank you for watching this video. Like, comment, subscribe, and I'll see you in the next video. All right.